Welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the deferred sales trust, is the best way for you to sell highly appreciated assets, cryptocurrency, businesses, primary homes, save a failed 1031 exchange, diversify the income into multiple investments such as stocks, bonds, mutual funds, insurance, and or real estate at any timing, all tax deferred, so you can create and preserve more wealth. Hey, I'm your host, Brett Swartz. In each episode, I'm joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. Hey, we're also streaming on expertcresecrets.com. So we also welcome all of our listeners there. Hey, I'm excited about our next guest. He's out of the Santa Barbara area, originally from the Northeast, kind of the New York, New Jersey area. He founded Mountain Vista in 2017. And Mountain Vista is a wealth management company with the objective of improving the access to quality financial advice for clients of varying asset levels. With 16 plus years of experience as a proprietary trader and portfolio manager at prestigious financial firms prior to founding Mountain Vista, he is uniquely positioned to help his clients develop and execute customized solutions to their financial needs and so much more. Please welcome to the show with me, Jonathan Heagle. John, how you doing?
Doing great, Brett. How are you?
Hey, better than I deserve. Excited to have you on the show. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Sure. So really, my background started in New York, really got into the mortgage space at an early age. Started off as a, subprime mortgage trader at Goldman Sachs for a number of years, kind of leading up through the crisis and, kind of the mania back in the day. Lived through the bust over there. And really, I had kind of a unique view as somebody who was involved in the creation, a lot of the mortgage debt at that point in time, and basically switched from being in a seat where we were creating the mortgage debt to actually actively trading that on the other side. So really kind of rode the recovery back in the housing market and, really kind of reaped a lot of those rewards. So really that back in 2016, 2017, that recovery largely took place. And also professionally and personally, I was kind of reassessing my life and kind of what I wanted to do at that time. Part of the fact that out of such a bad experience, positively affected me, I had a desire to kind of give back and help other people achieve success. So really, the move over to Santa Barbara was part lifestyle, but also gave me the chance to transition to focus on private wealth rather than just serving institutions. So, what do I do now is I basically, try to help my clients, achieve their financial objectives and financial dreams. That could be through traditional investments, through stocks and bonds, but also through private investments and real estate. And really try to help people navigate some of the benefits of investing in the different items while managing their risk. I think there's a lot of people, especially in today's market, looking at where stocks are and just uncomfortable with that level of volatility. So trying to come up with creative solutions to help people manage that.
Love it, John. Thanks for sharing that. I want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. So before we dive into the definition of a successful retirement and talking some strategies along the lines of what you're seeing in the real estate market, and I also want to touch on the correlation between the bust, right, and where we're at now, and any kind of patterns you're seeing there. But before we go there, I want you to think about, it could be high school days, it could be it could be college days, right? Maybe there's a strength, or some people call it superpower. I believe we've been given these gifts to be a blessing and help to others. So are there maybe one or two gifts that you kind of think of that you think that helps you to be a blessing and help to others?
I think, one thing that I think I do pretty well is kind of sift through a lot of information that's out there that you see in the news media, in the investment landscape, and kind of help distill it down to what's important. And that kind of helps me see through, some of what could be kind of a first level take on a situation, and really kind of see a step or two further in order to make sure that you're anticipating change and investing for the future rather than just taking something at face value. Because as we know in the markets, by the time you're reading something on the cover of the newspaper, your friend brings you a story. For the most part, that opportunity is missed. So I think that's kind of a unique talent that I have. Also, just I care about people, and I want to see people do better, and I kind of bring that integrity and that empathy to my relationships with my clients, where really it's less about me and more about kind of helping them out.
Very cool. So you're a strategic thinker. You take the noise and the information that's been thrown at us from all the media outlets and all the things that we're seeing here, and you distill it to what's actually important, and then you help your clients make good decisions based upon that. Is that a fair summary?
That's a fair summary.
Awesome. So now let's dive right in. So what's the number one secret to the definition or building a successful retirement?
I would say the first, setting up what your specific objective is. I think when a lot of people approach a financial advisor, a lot of times they're just thinking, I want the best investment return possible. But I think if you were to truly have somebody sit down and to try to say, let's think 15, 20 years in the future, how do you want your life to be? Like, what do you do on a daily basis? Where do you live? Who do you see? What do you do? Nobody's going to be talking about the balance of their investment account. So I think helping people reframe their focus and kind of figuring out how to get from today to that point that they envision in the future with some intention, I think that is kind of step one, kind of reframing the conversation away from short-term returns to what they want in the future.
Yeah, that makes perfect sense, right? Setting clear, specific objectives, like how do you want your life to be? Who do you see, where do you see you being, who do you see you being? What do you see yourself doing? All of those those key factors. And I think more and more people are looking for time, energy, stress, and location freedom, right? We're both in California. Right. You're in Santa Barbara, which is arguably one of the most expensive, not top 5 in the state of California, right? It's beautiful. It's an amazing area. It's one of a kind. I'm in Northern California, also very expensive as well. And you're seeing a lot of people who are looking for location freedom, time freedom, stress freedom, some tax, maybe a little more tax freedom, right? So what's been the biggest part of the definition of success for retirement as it pertains to some of these folks that you're seeing maybe downsizing or retiring, especially out of California? Any kind of trends or things that you're noticing?
So I think I'm going to answer the question slightly differently, but I think a trend that could be presenting themselves, particularly for real estate investors and kind of lending itself directly to your business, is, for a long period of time, a lot of people that are real estate investors have focused on building their portfolio and their net worth through continually deferring, their gains through 1031 exchanges into bigger and bigger properties. And I think with what we're seeing in DC right now, continually you're seeing real estate being one of the items that has gotten away without being attacked from a tax perspective, but constantly into the discussion. So I think coming up with strategies that go beyond just defer, then die and pass on all of that wealth to your heirs. I think people are going to have to get a little bit more strategic about how they take those capital gains over time and potentially find different strategies to minimize the tax impact on those embedded gains that they have.
Yeah, I couldn't agree with you more. In fact, that's part of why the 1031 is under fire. I have heard that they have taken it appears they have taken it off of the chopping block. It's not finalized, but it was, there's a lot of talk about taking it away. But part of the challenge that I think the government sees with the 1031 exchange is exactly what you said. A lot of people, trade, defer, and then dying at a stepped-up basis. And the IRS, in some respects, feels they're not getting their tax, right? What's owed to them. And this opposite is when 2008 crash hit, right? We're going to kind of tail this into the mortgage crisis, right? There was a lot of people, especially even in Sacramento. I was at Marcus Millichap, having people buy and sell multifamily properties. And one in particular deal, the gentleman is in 2006-07. We told him, hey, we think something's going to change. We think it's a great time for you to get out of debt, to sell, to diversify. and he didn't do it. And he literally $50 million worth of apartment complexes. He lost everything. He went bankrupt. And part of that was because he was 1031 exchanging and overpaying and chasing, and the music kind of stopped. And you look at that, and the government doesn't win, right? Because the thing goes to zero. Obviously, the person doesn't win there. And the biggest thing is they didn't have liquidity, diversification, and then the tax deferral. And that's part of what we provide here at Capital Gains Tax Solutions is an alternative to 1031 exchange. And we just helped another client for an 18-unit apartment complex sell. And it wasn't for him. It was tax deferral, but it was also time and energy. Like he goes, Brett, I have $40 million worth of real estate, and he goes, most of them are free and clear, very low basis. I just have so much stuff that I'm dealing with the government and changing the laws and rent control and managing the managers, and it just never stops. He goes, if I can just sell, and he put it all into the stock market, and like you guys just report and give me the income, and let's put it in a diversified liquid portfolio. He goes, to him that was transformation, right? Now, does he have 95% of or 96% of his wealth in real estate still? Yeah. So he's not like he's walking away from all of it. But for that one property that was a super painful one, he moved it, right? And now he's probably going to move other ones along the way as well. But could you just speak to diversification, liquidity, and the ability to be passive and alternative investments for real estate people? Alternative means stock market, right? But in big companies that are safe and liquid, can you talk about a little bit about that?
Sure. So the way I think about it, right now, I think all of the rage right now is meme stock trading and really aggressive kind of day trading type of behavior that we saw in the late 90s. And in reality, my core belief is that your asset allocation is going to dictate 90% of your returns. So people want to be really active, and they think it's really exciting to try to find the next Tesla when it's a $1 stock. Go for it. But really, I think most of your wealth is generated through asset allocation. So the way I like to view it is really kind of like a pyramid, right? So you have your core needs at the bottom, which are met through cash and short-term fixed income. Above that, you might have a little bit, corporate debt or higher yielding fixed income. Then you have your equity market exposure, some real estate exposure, and then up top you have your speculative investments like your cryptocurrencies and things like that. And I really think, there's no reason why everybody couldn't have access to all of that other than maybe their time and their education. But the benefits of having multiple different asset classes in your investment portfolio is not that you're going to have the top performance every single year, but you're going to be smoothing things out a little bit more. So if you do have a correction in stocks, you think about stocks and real estate historically, the financial crisis of 2008, 2009, that was unique in the sense that the crisis was basically brought on by bad mortgage debt. So you saw home prices go way down at the same time you saw equities crash. But in reality, what typically happens during a recession is stocks underperform, interest rates come down, real estate tends to be a positive performer, or at least not correlated with equities. So what that means is you have a more stable portfolio. One of the things I try to do with my clients is to kind of set them up for success behaviorally, right? So if you took somebody that had a mild risk tolerance, meaning they're able to take some volatility, said you should be 100% in stocks, and then the stock market goes down 20%, they're probably not going to stay with that strategy. And in investing, staying with the strategy is how you get the long-term returns that we know are so attractive. Over short periods of time, it's a coin flip, right? So by having exposure to fixed income, to real estate, potentially other private market investments, and then really high quality stocks, you can smooth that ride out a little bit and ensure that person can stick with that portfolio over time and ideally even be opportunistic, right? So if you do have that correction, well, let's take some of the money from fixed income and reallocate it towards equities. So a little bit more active, but what I try to do for my clients is be a little more strategic and tactical with their money.
I think that's super smart. And it's also what's cool about the deferred sales trust is you can sell high, diversify, get liquid, hedge and protect, do a lot of strategies to not be so volatile to the crash in the stock market too. But then when the real estate market shifts, you can go right back into real estate, all tax deferred, without using a 1031 exchange, which is really the Netflix light bulb that came on for me versus the Blockbuster 1031, right? Because in the 1031, you cannot trade like-kind investment real estate into stocks. I mean, you can go into a Delaware statutory trust, which is just another form of a 1031, but you give up all liquidity, huge fees, no control. Whereas with the deferred sales trust, you can go into securities, but then the investments can be reallocated back into real estate investment at a later date, all tax deferred with you. And so it's a really powerful strategy. By the way, you can learn more about that at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. But I want to touch on now, Jonathan, any patterns that you're seeing. You mentioned a little bit about the crash, right? And it was tied to mortgage-backed securities, and that ultimately kind of almost, collapsed the whole system, but you're looking at anything that kind of correlates, right? What are you thinking about high valuations on real estate? Do you see a correction coming, or what is the thing that no one's really looking at right now? And is it student debt, right? Is it something else there that you feel like we need to be watching out for that could be kind of like the mortgage-backed security of today?
So I guess let me first say that I'm generally optimistic on residential real estate with kind of a 5-year time horizon. That's just driven by purely demographics. The millennials are the largest part of our population, and they're, after deferring household formation and having babies and everything for a number of years, they're starting to hit the market in a big way. That being said, I think there are some things that get my risk antenna going. First and foremost, the amount of high appreciation that we've had, right? With mortgage rates probably hitting the lower end of the range that we're going to be seeing over the short term. So, and finally, there was actually some pretty interesting news that came out recently where Zillow paused their iBuying program and basically liquidated a bunch of their properties to institutional capital. So the risks I see to the market, if we were to talk about just what could go wrong, I see the potential for, overbuilding in certain areas where there's kind of high investor behavior, where if mortgage rates go higher, you end up in a situation where things become a little bit less affordable, and just kind of that price momentum goes away at the same time where you have additional demand coming online. In those areas, I could see a little bit of softness. That being said, I think if to a lot of people that are sitting there waiting for the market to adjust, I think the market should get, that supply should get absorbed with much more modest price declines than we saw in the past. So what's really different this time than really back in 2006, 2007 is the marginal buyers were all financed by really not distressed debt, but very aggressive debt, right? You didn't have to have your true income. You could basically just make up whatever you want. You can get 100% financing. Second liens as a means of covering the down payment were prevalent. If you think about it, the subprime mortgage market was $1 trillion in and of itself at the peak. Above that, you had what were called option arms, which basically allowed you to pay less than the payment, a very low teaser rate, and be underwritten based upon that, which was going to explode in the future when you had to make your full payment. So there are all these different risk layers that were prevalent back then. And really what happened was once the borrower became insolvent, they couldn't afford the mortgage. They couldn't refinance because nobody was lending anymore, and they had to sell or give back the keys to the property. I don't see that happening this time. So while we might have kind of a flatlining or stagnation in prices over time, I don't see that forced liquidation coming, unless these single family rental companies decide that they're all going to become sellers, right? So your Invitation Homes, your American Homes for Rent, these large institutional blocks of capital that have come into the market, if for whatever reason they became a seller, that would be a huge problem, specifically in areas where they're concentrated. I don't see that happening in any reasonable scenarios, but my risk antenna is up, especially looking at what happened with Zillow, and could that affect some local geographies? Perhaps, but I'm still pretty bullish. And I think the the demographic trend is really what's going to push the market forward in the next 5 years.
Fantastic analysis. You can learn more about John Heagle at mountainvistawealth.com, mountainvistawealth.com. And if you're in the Santa Barbara area, look him up. He's by the beach, and he's willing to help you out with your wealth management and strategy. And I love how you broke that down. I love that you have the connection with real estate. There's not a lot of financial advisors that have that intimate knowledge of what you have with what happened in the subprime mortgage market, right? And that real estate trends, and also the security side. Sometimes it tends to be, one or the other, right? So I really appreciate that perspective. And I want to pull one little nugget out of there for our listeners and remind myself as well, which is, are you overbuying or are a lot of people overbuying that are investors and where you're buying? But if you're buying in a single family home community with families, right, and of course, great schools and it's owners of these properties, right, they're owner occupying these properties, I guess is a better way to put it, with their families, they're less likely to see a huge drop in value in that a fair summary versus just investors that are buying, like the movie The Big Short, right, John? I read that book, right? They go down to Miami and they're talking to somebody, and she says, yeah, I've got like 3 or 4 rental properties, right? And they're like, you do on that income, right? So is that a fair summary of what I just said about what you said before?
Absolutely. And I do think, one of the results of the financial crisis too was the institutionalization of the single family rental market. So, a place where I own rental properties in kind of the Phoenix area, there's whole communities that are largely dominated by some small investors, but also these larger companies. So it is a big risk concentration. And really, for these guys, if there was ever a situation where they couldn't finance themselves, where they rely on securitization and other kind of complex and illiquid debt markets to finance themselves, if something changed there, maybe things don't look attractive to them. They step out of the market or they start to sell. So that could always happen. It seems like the demographic and the trends and the building trends aren't really leaning things that direction, but you never know. And it's always something to watch and pay attention to.
Fantastic, John. With that being said, are you ready for the lightning round?
Sure.
All right. Knowing what you know now, if you can go back to your 25-year-old self, what's the one golden nugget and make sure to tell yourself to do?
Buy Bitcoin.
Seriously, right? We just closed a Bitcoin case for a Google executive or a Google employee at one point. She's retired now from Google. She checked this out, John. She bought it for like $30,000, a bunch of Bitcoin, a long time ago. It went up to $50 million. Okay. She never sold 50 million. So we just sold the first 5 million, put it into a deferred sales trust to defer the tax. She lives in California. And now funds are being used to help her in a startup company. Okay. And then also in the stock market as well for some diversification, some liquidity. And so it's really exciting part of this world that we're in right now with that. So next question, what's your favorite book that you've recommended or gifted the most in the past year?
It's kind of a classic book, and it's a little bit of a cliche at this point. But I think going back even to your other question about what I would tell my 25-year-old self is, I think Rich Dad Poor Dad is a fantastic book, not just to kind of help people understand the value of real estate investing, but to help them think like an entrepreneur. And I think that's something great about the younger people we see now is entrepreneurship seems to be on the uptick. And when I was growing up and when I went to school, I believed that you had to get good grades and work hard and go work for a company, and somebody was going to be reliant upon giving you a paycheck for the rest of your life. And it worked out for me. Doesn't necessarily work out for everybody the same way, but I think entrepreneurship and really understanding the value of taking control of your finances and being more strategic, that's something I think more young people could benefit from.
That warms my heart again, John. You're getting most of our listeners are commercial real estate entrepreneur folks. So that's fantastic. And that actually leads into the next question. We just entered this segment and John didn't know this, but as a part of our lightning round, we talk about the Rich Dad, Poor Dad strategy. And we say like, what's your favorite, best kept secret that either you're applying or your clients are applying that you try to apply in your business and investment plan?
I would say what I'm trying to do that's most strategic is really looking at the whole picture. So if we go back to kind of from a pure investment perspective, don't just look at the one investment in isolation. Think about it in the context of other investments that you have. So if you have a lot of exposure to technology, think about what could hurt that thesis and then maybe try to buy something that benefits from that bad environment. So an example would be if you wanted to own, a high growth stock. We know that higher interest rates could hurt that position. Well, what would benefit from that? Owning something like financials, right? Which benefits from a steeper yield curve and they'll have more income. So think about how things work together rather than just in isolation say, should I buy Tesla? And then be very, not strategic about it. So think about the bigger picture.
Excellent. Love that. Love that. Love that. Another little bonus one for our listeners. It's I listened to Robert Kiyosaki on a podcast like a month ago, and he said the purpose of a business is to purchase real estate. And the premise was you got to think about tax flow, not just cash flow or appreciation, and using depreciation to increase your net cash flow by eliminating or reducing your taxes to be able to feed into either more businesses or more real estate. And so anyways, I thought that was a really unique way of thinking about that. That's a little extra golden nugget for you there. So next question is this. What are you most curious about right now, John?
I would say what I find really curious about what's going on is the world is changing so quickly. And I think I don't understand it, but I'm really intrigued by what's going on in the NFT world and a lot of the digitization of so many assets. And I think about it in the context of real estate, right? It could be as simple as, bringing title onto the blockchain, right? And you can basically eliminate the need for title insurance at that point. But really, could you even be tokenizing ownerships in real estate? And could I sell a fractional share of my house as a means of time, releasing some of the equity rather than having to go the traditional finance route of getting a home equity loan or something like that. So there's going to be so many changes that this technology is going to bring. And that by definition means there's incredible opportunity right now in terms of new businesses and new investments and things to be made. I wish again, you say, what do you wish you could tell your 25-year-old self? I wish I could tell my 50-year-old self how things are going to play out so I can best position my clients and myself to kind of take advantage of that. But I just think the next 10 years are going to, 5X what happened in the last 10 years.
Yeah. And to that point, I have a friend and a gentleman that I've been mentoring. He's in his 20s, but he's starting to mentor me on cryptocurrency. He's 21, and he literally bought an NFT about a month ago for about $14,000, and the value over a 30-day period went as high as $1 million. Like just insane amount of rapid appreciation. He's looking at the deferred sales trust. We're going through all this stuff now, and but it's really interesting to see the change and that's happening in the cryptocurrency world. Bitcoin, Ethereum hitting all-time highs. And it's happening fast. Last question, John, we're running out of time. After all your success, all the families you've helped and the individuals you've helped, your experience in real estate and securities and in retirement planning, how do you stay centered in your values and how do you stay encouraged to charge forward to reach new heights?
I'd say I stay centered in my values in terms of, I've got 2 young daughters at home and with my wife. And, I see them on a daily basis and I kind of think about what do I want to instill in my kids and how do I want them to be when they grow up. And it kind of helps me be a little bit more self-reflective about, who I am as a person and kind of how I put myself out there to the world. So, I want to be a good example and a good father. And that kind of helps me stay motivated to kind of, improve myself in all aspects of my life.
Beautiful. John Heagle, for our listeners who want to get in touch with you, would you remind them one last time what's the best place for them to reach you?
Sure. So you can, go to my website, mountainvistawealth.com, click the Start Here button, schedule a time for us to chat. I'm happy to speak to anyone. I'm also on LinkedIn, Jonathan Heagle. Again, pretty easy to find. So those are probably the two best ways to connect with me. I look
Awesome,
forward to
John.
speaking to anyone in your audience. So.
Perfect. Thanks, John. Hey, thanks for being on the show. I encourage you to keep using the gifts and talents you've been given as far as taking the noise and information and distilling it into what's important and being strategic about it and helping your clients create and preserve more wealth in real estate and securities and retirement planning. I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the deferred sales trust, is the best way for you to exit highly appreciated cryptocurrencies, NFTs, primary homes, businesses, save a failed 1031 exchange so you can create and preserve more wealth. You can go to capitalgainstaxsolutions.com right now. We have a free mastermind, by the way. I want to invite you to, and your friend to, and your CPA to, whoever's out there that wants to learn about the deferred sales trust. We call it, it's the DST Cryptocurrency Mastermind every Friday. But we talk about the sale of businesses, real estate. We bring on past clients, frequently asked questions. There's no bad questions. It's totally open to everybody every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern Time. You can go to capitalgainstaxsolutions.com and there's a banner. It says register for the mastermind. Click on that. Join us. Come learn about what we're doing. Also, you can check us out on YouTube and all of the other major iTunes and Spotify channels that you might be listening to this out. And then lastly, Expert CRE Secrets. If you're a real estate professional, M&A advisor, business broker, you want to check that out by going to expertcresecrets.com. Thanks everyone for watching this show. Please rate, review, subscribe. Please share this with somebody. We'll talk.